Most investors obsess over their annual returns. But did you know that in one 72-hour stretch of legal uncertainty last year, $24 billion quietly disappeared from equity portfolios? If you've ever checked your balances after a major court ruling and wondered why the sudden plunge, this episode is for you. Here's the overlooked risk almost nobody talks about: compounding uncertainty, which can erode your wealth far faster than any market downturn if you aren't prepared. And get this, every year you ignore this hidden threat, you might be costing yourself tens of thousands of dollars in lost compounding. Today, I'm breaking down the real numbers and the framework I use to sidestep these invisible setbacks, including 3 proven tactics for protecting your portfolio through political chaos. Stick around, because missing just one of these could mean thousands lost. And I'll show you the free checklist you can use to audit your own financial blind spots. Let's get started. But first, remember, the strategies discussed are for informational purposes only and not individual investment advice. Always consult a licensed professional before changing your portfolio. Let's set the stage by getting honest about why legal decisions like today's epic ruling by the Ninth Circuit Court of Appeals matter so much. Most headlines talk about protocol shifts, but the actual ripple effect goes much deeper. When the Ninth Circuit lifted the block on federalizing the National Guard, it wasn't just a legal maneuver. It fundamentally blurred the lines between state and federal power. And when those boundaries shift, markets, retirement accounts, and local economies all feel the tremor. Here's the financial reality. Investing isn't just about compounding returns. It's also about managing compounding uncertainty. And as every seasoned investor knows, uncertainty multiplies losses faster than any bear market if left unchecked. Think about it. For every period of policy whiplash, there's broad confusion. According to Vanguard's 2020 study, legal instability has directly contributed to periods of 10% plus volatility spikes across major indices, leading to shorter windows for recovery and increased drawdowns, especially for portfolios with concentrated risk. Now, what happened today was a stay, not a final decision. But in real terms, it cracked open a door that's rarely closed quickly. The executive branch is now operating in a legal fog, and when leaders of nearly 30 federal agencies, departments like Homeland Security and the National Guard are uncertain, decisions become reactive. In finance, this is like losing your investment policy statement. You can't execute a plan if the rules are being rewritten on the fly. First, let's break down what this means for your money. When institutional clarity collapses, so does market confidence. We've seen this repeatedly during periods of sudden power shifts, such as in 2011, when the debt ceiling debate paralyzed Congress. The S&P 500 dropped nearly 17% in less than a month. When legal authority is questioned, markets hesitate. Capital dries up, and institutional investors rush for safe havens. That fear compounds, literally. Here's a quick micro call to action for you. Have you ever noticed your portfolio tank faster during weeks of political headlines? Drop a yes or no in the comments. Seriously, I want to know how many in our community feel these shocks in their actual numbers. Now, to understand why, let's dig into today's ruling, which legal experts are calling the most robust check on presidential power in recent memory. I'd go further. This is a structural reset, not a simple political correction. The Supreme Court didn't just strike down a single order or embarrass a leader. It dismantled an entire architecture of authority that millions of investors and systems had grown dependent on. In finance, the lesson is direct. When you build your portfolio or your strategy on leverage without sufficient oversight, the crash is inevitable. In politics, that leverage is executive authority, and today it was called to account. Key point: 3 of the justices striking down the executive's order were themselves appointed by the president, whose power they curbed. That's a quintessential lesson in governance. Influence does not mean ownership. So when people talk about stacking the court, the reality is, institutional framework always matters more than loyalty. In my 15 years analyzing portfolios and governance models, every time a system bends to the will of one person, judgment gets distorted, and long-term value crumbles. Now here's your first curiosity loop. Most people think legal rulings are only tangential to investing, that political news is just noise. But I'm about to show you real case data on how ignoring legal risk led to tens of thousands in lost compounding for disciplined, diversified investors. Don't click away. The numbers might change how you manage your next move. So let's talk about how power, when unchecked, generates a kind of systemic rot. The Supreme Court ruled that presidential overreach, specifically control of agencies and even state National Guard units, violated the deep-seated separation at our republic's foundation. Here's why that matters. If authority piles up in one branch, even temporarily, you're not just changing laws, you're shaking the invisible social and market contracts that let economic confidence exist at all. And the numbers tell the tale. Historically, market volatility increases to 15% in the 30 days following Supreme Court rulings on executive overreach, according to BlackRock's Political Risk Index. Meanwhile, multi-manager portfolios with high exposure to affected sectors like defense infrastructure, federal contracting, underperformed diversified benchmarks by as much as 3.8% during these gray zone periods. Next, let's highlight a real example. Time for our pattern break with a concrete case study. In August 2019, when the Trump administration rapidly shifted authority over border security via executive order, the S&P 500 lost 5.9% in just 14 trading days, while infrastructure, ETFs with heavy government contract exposure, dropped over 11%. Investors who kept more than 40% of their portfolio in a single sector saw drawdowns 2 times deeper than those who remained broadly diversified. One of my subscribers, Sarah, who shared her statement with me, had $225,000, her retirement portfolio. She held almost $100,000 in a government contractor ETF. In the aftermath, she saw an $11,000 drawdown that took over 18 months to fully recover, while her balanced index fund positions rebounded in half the time. Don't let this lesson go unnoticed. Legal fog ripples instantly through chains of a command. If you treat authority as a shortcut in your investments, over-leveraging one fund, blindly following one sector, you'll pay for that shortcut with real losses. In the macro environment, federal agencies described the current disruption not as a delay, but as a system-wide reset. That's why every historical episode like this becomes a live drill in systemic risk management. Now, a recap before we introduce our practical framework. Today's legal chaos isn't just a news item. It's a signal that when government rules get cloudy, markets suffocate. When rules blur, capital withdraws, hesitations for wits and trust contracts. That's what leads to those double-digit drops you see in your balances. Take this shareable insight with you. Uncertainty compounds faster than interest, but so does preparation. I'll show you how to harness that preparation. Next, before we dive into strategy, it's critical to add, the following 3 tactics are educational only, not tailored to your unique finances. Always speak to a fiduciary advisor before making adjustments. Here's the framework. 3 ways savvy investors hedge against legal and political risk. I use these myself, and I've seen them protect millions in portfolios I've reviewed. Let's walk through a backed by hard numbers and real-world outcomes. First, diversification across political exposure. This means not just spreading across sectors, but being intentionally aware of exposure to government-dependent revenue. According to State Street Global Advisors, portfolios with less than 20% allocated to defense healthcare and federal contracting weathered the 2017 to 2022 policy cycles with, on average, 4.1% lower drawdowns than portfolios exceeding 40% exposure to those same sectors. The key is stress testing your portfolio for sector reliance. Use free tools like Morningstar's X-ray or Personal Capital to break down your asset sources. If more than a third of your portfolio depends on any single political outcome like infrastructure funds, defense stocks, and so on, you're carrying outsized legal risk. Here's your action. Pause and review your current allocations. How much is at more at the mercy of future executive orders or policy swings. Comment below with your sector breakdown or list your main ETF tickers if you want peer input from the Ray Invests community. Second, hold strategic dry powder. In practice, dry powder means keeping at least 20% in highly liquid assets, think cash, high-yield savings, or short-term Treasury ETFs like SHV or BOMBSHELL ready for deployment when political risk creates market overreactions. During the 2020 election volatility, investors who maintained a 15% cash buffer outperformed fully allocated peers by 2.3% on average, according to Fidelity's election cycle research. Brief. That dry powder let them buy quality names at a discount when volatility spiked, rather than panic selling at the bottom. Personally, I keep at least 3 months' expenses in a high-yield money market fund, currently yielding around 4.5% APY, as both my psychological safety net and my strategic opportunity bucket. Microcheck. Do you have a dry powder strategy already? If so, drop a yes. If not, what obstacles hold you back from building one? Peer advice often helps more than theory. Join the discussion. Third, systematic rebalancing in volatility windows. Research from Vanguard shows that portfolios rebalanced quarterly during legal or political shocks rather than left on autopilot recovered their pre-crisis value as much as 30% faster, often cutting time underwater by 6 months or more. The logic. These windows create sector mispricings, and without a disciplined rebalance, you risk concentration creep. Implementing this can be as simple as setting calendar reminders or using robo-advisors with auto-rebalancing features. Wealthfront Betterment, Schwab Intelligent Portfolios all support this. Now before you go automate, I want you to screenshot this 3-step framework or jot it down. In moments of market or legal stress, run through 1. What's my sector concentration? 2. Do I have deployable cash for opportunity? 3. Am I overdue to rebalance allocations? Keeping that checklist close prevents emotional decision-making when headlines strike. Here comes your curiosity loop. But what about those silent taxes investors almost never see? Stay with me for a minute, because I'll show you exactly how legal risk becomes an invisible drag on compounding, costing disciplined savers tens of thousands over a decade, and how top portfolios sidestep those hidden hazards. First, though, a quick recap to ground what we've covered. We started with today's Supreme Court response, move, that shook institutional clarity and triggered shockwaves in capital markets. We examined how systemic risk replaces normal market signals with paralysis, using both historical and current data. And we highlighted a live case study, Sarah's $11,000 drawdown from overconcentration, contrasted with a diversified and liquid peer. Now, let's dig into the science of legal risk as an invisible wealth tax. You see, legal instability doesn't just impact sector prices, it reduces your expected return through what's called risk drag. According to BNY Mellon's 2022 Market Impact Review, portfolios exposed to legal and political shocks experienced an average of 1.2% annualized underperformance per year, largely due to price stagnation and missed compounding while assets are under review or sidelined in legal limbo. That's what I call the silent tax. A $100,000 portfolio could forfeit $15,000 in growth over 10 years versus a more defensively structured sibling. So here's another micro engagement for you. What's one market or policy event you wish you'd better protected your nest egg against? Was it Brexit? The 2011 debt ceiling crisis? The 2020 election? Drop your story below. We learn fast when we don't repeat the same mistakes. Bringing it all together. Markets punish concentration, but they reward preparation. When legal overreach or court reversals hit, prepared investors deploy dry powder, rebalance with discipline, and steer clear of dangerous concentrations. That's why institutional funds think CalPERS and TIAA systematically hedge exposure during policy cycles, and why Warren Buffett famously keeps at least $130 billion in cash and U.S. treasuries on his balance sheet. As we head toward implementation, let's recap and then move to tools and resources. Recap. 1. Diversify by exposure, not just by ticker. 2. Keep strategic dry powder ready for opportunity. 3. Schedule systematic quarterly rebalancing, especially during or after major legal shocks. These 3 steps, when kept on rotation, have protected my community and millions in collective assets from the worst aftershocks of legal chaos. For those who want to take this to the next level, I've created a downloadable checklist link in the description that walks you step by step through auditing your sector exposure, calculating your personal risk drag, and setting up that behavioral safety net for the next round of policy turbulence. There's a matching portfolio triage template modeled after the same one used by wealth managers during extreme events. Before we close, here's the bottom line. Elections headlines and court rulings will always create volatility. You can't eliminate risk, but you can systematically strip out the avoidable, compounding uncertainty that catches most investors off guard, markets, and nations. Reward those who focus on the long view and have a process in place before the chaos hits. Final compliance reminder. These strategies are provided for education, not personal investment advice. Every portfolio is different, so please consult a fiduciary advisor for guidance. Past performance does not guarantee future results, and all investing involves risk, including loss of principal. So in summary, legal shocks, like today's, don't just punch politicians. They shake markets and personal wealth. But if you build your process around preparation, not panic, your portfolio becomes resilient, not just reactive. Let's set up your next steps together. If you haven't already, subscribe to Ray Invests for real-time breakdowns and insider frameworks the moment legal headlines hit. Leave a comment, letting the community know which of the 3 risk management tactics you're prioritizing. And don't forget, download the asset protection checklist and worksheet in the description to immediately assess how much unexpected risk you're really carrying. Preparation compounds just like interest, so start stacking it today. So let's close with a quick recap. Today, we dove into why legal and political uncertainty isn't just a news cycle footnote. It's a repeat, measurable threat to your financial future. We traced how power shifts, Supreme Court rulings, and blurred government lines have cost disciplined investors billions using real data and subscriber stories. Then we broke down the 3 tactics. 1. Diversify consciously to reduce legal exposure. 2. Hold and deploy strategic dry powder. And 3. Rebalance systematically, especially when volatility spikes. These steps, along with our companion checklist and triage worksheet, link in the description, can insulate your portfolio from uncertainty that compounds losses as fast or faster than any market downturn. Here's what you can start right now. Today, run your portfolio through a free tool like Morningstar X-Ray or Personal Capital and note your sector exposures. This week, audit your liquidity. Set a target for your dry powder allocation. Within the next 60 days, put a quarterly rebalance on your calendar. Stick to it, no matter how distracting the headlines get. And remember to grab the free asset protection checklist and triage template so you can benchmark your own risk the way pros do. You'll likely see more financial calm within a single news cycle often. Just having a written process is enough to turn panic into preparation. Within 3 to 6 months,
the disciplined use of dry powder and scheduled
rebalancing can turn market chaos into long-term buying opportunities, and a year from now, your returns will reflect the benefits of compounding preparation, not compounding uncertainty. Now, if you haven't subscribed to Ray Invests, hit that button and turn on notifications so you never miss a timely breakdown. Leave a comment with which of the 3 risk management tactics you're prioritizing right now, 1, 2, or 3, and why. Download the asset protection checklist and worksheet in the description to start stacking your preparation today just like the pros. Remember, the strategies discussed here are for educational purposes only and not individual investment advice. Always consult with a licensed financial professional before making changes to your portfolio. Past performance does not guarantee future Results and all investing involves risk, including the loss of principal.